Good morning, everyone. I, Tahsin Sultana, Assistant Professor, Department of Commerce, Government First Grade College, Prajatam. In this session, I will be discussing tax aspects of investments. Learning objective of this chapter aims to provide overview of security analysis. The session outcome is students will be able to understand the tax aspects of investments. Now, in this session, let us start with framework for income tax. For understanding this concept, we should know these terms, terminology of income tax. Taxable income is the amount of income used to calculate how much tax an individual or a company owes to government in a given tax year. Determination of taxable income. Every tax season, individuals calculate their income to determine how much tax they are supposed to pay. Learning how to calculate taxable income involves knowing what item to include and what item to exclude. You need to know your filing status and add up all of your sources of income, then subtract any deduction to find the taxable income. Assessment year is the year following the financial year in which income is assessed. This also lasts from 1st April to 31st March and is the year in which you file your income tax return for the tax paid in the relevant financial year. Tax rebates. The Income Tax Acts provide certain tax rebates, and these are deducted from the gross tax payable to arrive at a net tax due to the government. The rebate relevant for our reference will be section 88 and 88B. Advance tax. The estimated net tax due is required to be paid during the financial year in which the income is being earned as advance tax. In three installments on or before September 15, December 15, and March 15 succeeding, covering 30%, 60%, and 100% of the advance tax payable respectively. In determining the advance tax, the estimated tax that may be deducted at source by other has to be deducted from the estimated net tax due. This is the income tax slab for 2021. Tax aspects of investment, we should understand what is investment income first. Investment income is income that comes from interest payment, dividends, capital gains collected upon the sale of a security or other assets, and any other profit made through an investment vehicle. In very simple terms, we can say that it refers to solely to the financial gains above the original cost of the investment. So you may ask me, what is investment vehicle? Investment vehicle is a product used by investors to gain positive returns. It can be of low risk or it can be of high risk. The example of low risk will be certificate of deposit or bonds, and the examples for high risk will be stocks, options, and futures. Suppose you take an example and try to understand this. Suppose an individual buys stock of company ABC for 50 rupees. He keeps that for 2 weeks. After 2 weeks, he sells that for 70 rupees, netting a profit of 20 rupees in the process, which will be called as investment income. And then the income he earned from that investment of company ABC is considered as investment income. It will be taxed accordingly. Types of tax on equity investment will be of three types: security transaction tax, capital gain tax, and dividend distribution tax. Now, security transaction tax, it is levied on purchase or sale of securities which are listed in the stock market, such as equity mutual funds and derivatives. The investors have to pay tax on each transaction as of 2017 December, it is 0.1% of the total value. Capital gain is the profit earned when we sell a security at a higher price compared to its purchase price. For example, if we buy shares of a stock X for 10 lakh rupees, we hold this for 4 years. After 4 years, when we sell this, the price will not be same. Okay, the price we may gain will be 12 lakhs. We will sell it in the market for 12 lakhs. So here we will be gaining 2 lakh rupees. So based on the holding period, capital gains are taxed differently. It will be short-term gain or it can be long-term gain. If the investment in shares will be held for less than 12 months, any gain earned on these transactions considered to be short-term capital gains, subject to a tax of 15%. Long-term capital gain, any gain on shares held for more than 12 months considered to be long-term capital gain for equities that are listed on the recognized stock exchange such as BSE and NSE. As of now, long-term capital gains are exempted from tax only if for the transaction for which you have paid SST, that is security transaction tax. Tax on gain from government bonds. The first one is tax on interest from regular taxable bonds. The income from these bonds should be listed under income from other sources and it should be taxed accordingly. Tax on interest from tax-free public sector bonds. In this case, the interest earned is completely tax-free. If the investors hold its bond and it gained appreciation, then the appreciated value will be taxed. Investors will be taxed if there is any appreciation in the value of bond at the time of sale in secondary market or during redemption period. Tax on capital gains from sale of bonds in the secondary market. Capital gains from sale of bonds will fall under short-term taxation or long-term taxation based on the tenure of holding the bond. The tenure of holding for short-term or long-term is different for listed and unlisted bonds. For listed bonds, under the long-term capital gain, if are held for 12 months. Unlisted bonds, in order to qualify for long-term capital gain, the holding period has to be more than 36 months. Tax on gain from mutual funds investment are of two types. Taxation of equity-oriented mutual funds, a scheme that predominantly invests over 65% of the portfolio in equity shares in domestic company is called as equity-oriented mutual fund schemes. And second one is taxation of debt mutual fund schemes. Long-term capital gain on debt mutual fund unit held for more than 36 months are taxed at the rate of 20%. I hope the concept is clear. Let us go for multiple choice question. The first one is capital assets like equity shares which are listed in the recognized stock exchange in India will be treated as short-term capital assets if they are held by the taxpayer for a period not more than dash months preceding the date of its transfer, 12, 24, 36 or 48. The answer is A, 12 months. Second multiple choice question. Short-term capital gain other than covered under section 111A is charged to tax at options are 10%, 15%, 20% and normal rate of tax which is determined on the basis of total taxable income of the taxpayer. D is the right answer. Third multiple choice is the charging section of the income under the head capital gain is section 15, 17, 10 and section 45 2. The answer is D. Fourth one, what are the conditions to be fulfilled for charging of income under the head capital gains? Options are there must be a capital asset, there must be a transfer of such capital asset, the transfer of such capital assets has been effected during the previous year. The answer is D, all of the above are necessary. The following shall be regarded as capital asset: gold jewelry held by jeweler, security held by FFI as per SEBI Act 1992, held as stock in trade, motor car held by motor car manufacturer as SIT, none of the above. Answer is the securities held by FII as per SEBI Act of 1992. Thank you very much.